All right, guys. So I am Stephanie Hill, the luxury move up specialist, as you know. And today we're going to be talking about what's going on in the real estate market. Today, specifically, we're going to be talking about all things credit and the Biden administration initiative. I know a lot of people have questions, and I wanted to get the source of the information and find out what's real and what's not. So I have as my special guest, one of my favorite lenders, Jeri from Fitzgerald Financial. And we are going to cover all the questions that you guys asked already, and then some too. So Jeri, I have a first question for you. So
Sure.
just to kind of set a baseline, how does your credit score impact your ability to actually obtain a mortgage? I think maybe if we kind of start with that, then we can build from there.
So you need good credit to be able to get a mortgage. And we're kind of looking at a threshold of a 620 or greater to be able to get a mortgage.
And is that your middle score, your high score?
Your middle score. There's 3 bureaus, so we're looking at the middle of the 3. Okay. So we need at least that 620.
Oh, question for you, and this is asked a lot. Going along with the credit score, when you are applying as maybe a couple, whether you're married or not, how does that work? Like, whose credit is taken into consideration?
Both borrowers have to have at least a 620, and we're always going off the lower borrower's score.
Okay, so say Stephen and I are going to apply for a mortgage. If I have a 700 middle score and Stephen has a 720 middle score, then it's my 700 that's considered, right? Okay.
That's right.
Gotcha. Okay, that makes sense. So when we talk about those ranges of credit scores, and you said, roughly 620 is where we want to start, is that because like that's the lowest that it can get, or is that because that's what the payment programs are?
It can go much lower, but that's the kind of the bottom line of what we will work with.
Okay. Gotcha. Okay, that makes sense. So how should people check their credit score? Like a lot of times, we have like credit cards or other things that give us
the best site to go to is annualcreditreport.com. That's the government portal that'll get you to all 3 credit bureaus. And you may have to pay for your score, but at least that'll give you all the real information. If you want to do one of the score monitoring, you could like look at Credit Karma. But just know what shows up on Credit Karma is the consumer score. It's going to be higher than the mortgage score.
Okay. So with the free annual, what is it again?
www.annualcreditreport.com.
Okay. So with that, you're entitled to a free credit report every 12 months, but not the credit score, right?
That's correct. So if you want the scores, you have to go to one of those monitoring services.
Gotcha. Okay. Another question for you. So if you do use like Credit Karma or some of those others, like how accurate is that as compared to what a lender might see?
So they're going to be 20 to 30 points higher on Credit Karma than what we get as a mortgage, because that's a consumer score. So it's a different modeling than what we use on the mortgage side. So just know that score is higher than what we actually work with.
Okay, that's helpful. Another question about credit score and like looking to purchase things, whether it's an investment property or whether it's a, single family or residential property that you want to live in. When you're thinking about like, what do the lenders look at when they're looking at your credit report and your credit score? Are they seeing like if you pay things on time or that everything's paid off?
They're looking at the depth of your history, how you've paid your credit, and do you use your credit in what we call a wise manner.
Okay.
So if somebody's got a credit card with $1,000 credit limit, they don't, 30% is what I call the sweet spot. So you never want your balance at any given time to exceed 30%. That's a good thing. If somebody's taking that $1,000 credit limit and they're running it up to $950 every month, the bureaus look at it like you can't manage your credit card usage, or worse, if you go above your credit card limit.
Okay.
That's even worse to your score.
So having that $999.99 balance on that $1,000 limit is probably not the best.
No,
but do you have to pay it off when you're applying for a mortgage, or do you just have to keep it, within a reasonable amount?
Keep it under that 30% mark.
Okay. One more question about this. So a lot of times people often ask me when they're getting ready to apply, they say, well, Stephanie, should I like pay things right before I get an approval, or should I talk to the lender? Like, what do you recommend?
Talk to me, because if your score is not where we want it to be, or maybe I can improve things for you by just getting a couple points, we have a great partnership with United One, and they're the ones that do our tri-merge credit report. So if I need a couple points, I reach out to them and I'm like, hey, what's my cheapest way to get me to a 640 or a 740? So they're a great resource that we have at Fitzgerald Financial to be able to boost somebody's score and get them where we want them to be.
And that's important too, because, you know, there's a big difference, guys, from using, what do they call them? Credit repair companies, and actually talking to a lender about what you strategically need to do to get a mortgage. Because
I'm not a credit repair, but we can give you suggestions, and then you can work with those suggestions to, you know, get on the right path.
Yeah. And that is actually way more accurate, guys, because the lender is telling you, hey, these are the things that we're seeing, and this is where we need to go in order to get you an approval for a loan. So you kind of have a more direct path versus someone who may not necessarily know all the ins and outs of mortgage lending. All right, that makes sense. So now that we've kind of talked about credit, the credit scores that we need, how does someone's credit, or what factors weigh into interest rates?
So on a FHA mortgage, they're not as credit score sensitive as a conventional. So somebody with a 660 credit score is going to get the same interest rate as a 760 credit score. All right. So that's the nice thing about the govies, or the government loans. All right. Conventional has always been credit score driven. Mortgage insurance, private mortgage insurance, which is required on a conventional mortgage if you don't put 20% down, has always been credit score sensitive. So the higher your score, the better your terms.
Okay. So I know sometimes people ask, like, well, which one is better? Should I try to get an FHA or should I try to get a conventional? What are the key differences between those two?
So if somebody's got, right now, FHA cut their mortgage insurance earlier this year, so they really reduced it. So if somebody's got like that 720 to 740 and underscore, I'm going to look at both, because could be that FHA is a better deal than a conventional. By the time you take the higher interest rate with a conventional and the higher mortgage insurance, you may be able to get a lower mortgage payment on an FHA with a smaller down payment.
And so with the FHA loans, the mortgage insurance premium, that stays with the life of the loan, right? So
that is correct. Yep, that is correct.
Okay.
But I tell everybody, the mortgage to get into the house is not necessarily your mortgage you're going to keep for 30 years. I don't know anybody that has kept their original mortgage for the full 30 years. It just doesn't happen.
And that's important to know too. Like, you know, what you use now, you may down the line choose to refinance and get a conventional or something else. So, you know, think about all of those factors when you are seeking to obtain a mortgage. Okay, so let's dive into this new initiative. I really want to understand it. There's a lot of questions and a lot of confusion. And so one thing that has constantly came up when I asked a poll about what people wanted to know is, do people who have lower credit scores get better interest rates than people with higher credit scores under this new?
No.
Okay.
So nobody's punishing the people with good credit scores. None of that stuff.
Okay.
So
Let's say that again.
All that fake news. Okay.
Okay.
So what's happening now is there's something called loan level pricing adjustments. And we've had this everything in our world has been risk-based pricing for years. So this is nothing new. These changes went into effect earlier this year. They're just now being heard about because the May 1st deadline is when the loans have to go to Freddie and Fannie. So just know that everybody since the beginning of the year, this has already been in place for them. All right. And what it's doing is it's breaking down a grid. What is your credit score range? What is your loan to value? How much are you putting down? All right. So, you know, people with lower credit scores are still going to pay a higher interest rate than somebody with the higher credit score.
And that was how, you know, that's just traditionally. If you have a higher credit score, you get a little bit better rate. If you have a lower credit score, then
that's why our partnership with United One is key, because I have literally taken people from that 738 to a 740 to improve their terms.
Gotcha.
You know, it can make a big difference.
Gotcha. Okay, so just to recap, guys, if you have a higher credit score, you are not being penalized. You are not paying more than someone who has a lower credit score.
You're not subsidizing.
Just because you have a higher credit score. So let's let's grab that, okay? So let's talk about, you mentioned like the, the technical terms, but let's kind of jump back for a second. So with that new change, like what does it mean for the average person who's getting ready to, try to obtain a mortgage now? Like, do they need to do anything differently or consider anything?
It's more important for me to pull your credit in the beginning so we know what we're working with.
Okay.
Because if you are not even looking till this summer, but you apply now and we want to make some changes, we have that time to make the changes to get your score higher, to get the best terms possible.
Okay. Okay. That makes sense. That makes sense. Okay. So when someone is ready, say they decide like, okay, I've done my research, I've saved my money, etc., and I'm ready to go ahead and try to get a mortgage. What's the first thing they should do?
Do an online application at jeribenner.com.
Okay, you heard that. Do an online application at jeribenner.com. And then you can also DM me. I will walk you through everything. We'll set up a call, talk about what your real estate needs are, what your goals are, and then we will link you up so that you can get everything taken care of. All right, so Jeri, any other last parting, thoughts about anything related to credit or mortgages before we go?
Pay your bills on time.
Yes, yes. Okay, that's really
very
important.
important.
Very important. So when you guys think about your credit score, payment history makes up 30% of your credit score. So just simply paying your bills on time will have the biggest impact of all of the things that you can do. So you absolutely want to keep it, below the 30% debt ratio that Jeri mentioned, but just pay your bills on time. That's all. And try not to take on extra debt if you can. So, last question.
Sure.
How do student loans impact someone's ability to get a mortgage, whether it's FHA, conventional, etc.?
So even if they're in deferment status, I have to use 0.5% for an FHA of the balance.
Okay.
Right?
So can you give me like a really, really, really simple example? What does that mean?
So if you've got a balance left on your student loan of $10,000, I have to use 0.5% in that debt to income ratio calculation. Conventional, it's 1%, or it could be 1% or 0.5% depending upon Freddie or Fannie. So
how does that work now with like the deferment?
Basically, because it's all showing up as a zero payment, so I have to count something in your debt to income ratio. So whether it's $50 or $100 in that example, it doesn't, it's one or the other. I have to count something.
Okay.
Eventually,
but
you got to start paying the bills.
Eventually, but who knows? Well, finger crossed. But in the meantime, guys, if you have any other questions about real estate, lending, anything else, feel free to drop it in the comments or DM me, and we will absolutely discuss it on the next episode of What's Up with the Real Estate Market. So signing off today, I am Stephanie Hill, the luxury move specialist.
And I am Jeri Benner from Fitzgerald Financial.
All right, guys. See you next time. Bye.
All right, bye.